Nash.
Thank you very much, Mr Speaker. I also rise to support the Insurance Prudential Supervision Bill 2009. This bill is important to the people of New Zealand for three reasons, and it's these that I will outline and elaborate on. The first being that this bill is another step in achieving clear, robust laws and regulations across the financial sector. The second is that it will provide a much higher level of security to New Zealanders with exposure to the insurance industry. The third reason it is important is because it tidies up legislation around a sector where there was an unacceptable level of uncertainty. Mr Speaker, tightening legislation, regulating an important segment of the financial sector and providing certainty are the three reasons why Labour is supporting this bill. These measures will help provide confidence for all New Zealanders that their Parliament is working together to further protect their rights and their money. Mr Speaker, New Zealanders have lost a significant amount of money in this economic recession. New Zealanders who worked incredibly hard, saved hard, dreamed, aspired, and should be allowed to live and retire with dignity. Parliament has already passed legislation in several areas to tighten or make laws where there really was a deficit in the financial sector. And this is just another step in ensuring that hard-working Kiwis can have confidence in the New Zealand financial sector, and this is what I mean when I say that this bill is another step in achieving clear, robust laws and regulations across this very important sector of the economy. It is not only sensible, but it's absolutely necessary in this day and age. And it's why we all work together across parties, across all parties, on this type of legislation that actually benefits all New Zealanders. Now, while the New Zealand insurance sector is not generally in distress and was not in distress during the heights of the economic recession, the global financial crisis has demonstrated the vulnerability of the financial sector as a whole. Currently, New Zealand does not have a framework for the prudential regulation and supervision of insurers. Current insurance legislation is outdated and inconsistent in its application across the diversity of the New Zealand insurance market. Now, Mr Speaker, there has been extensive consultation on the provisions of this bill. A draft version of the bill was released for consultation in April 2009. The draft bill reflected policy approvals by Cabinet in December 2007 and August 2008. Prior to this, the proposals originated in the review of the Financial Products and Providers Workstream. A discussion document was released by the MED in September 2006. A further consultation paper was released by the Reserve Bank in May 2008. The second reason why I support this bill, Mr Speaker, is because it provides a much higher level of security to New Zealanders with exposure to the insurance industry. The bill requires all insurers operating in the New Zealand market to be licensed and supervised by the Reserve Bank and to comply with minimum prudential requirements. The Reserve Bank will have powers to act in respect of insurers who are in distress or in other difficulties, and I will elaborate on these points in a minute. Having said that, Mr Speaker, in the end the new regime has been designed around a self-managing approach. For example, insurers are expected to devise and adhere to their own fit and proper risk management policies, subject of course to bank oversight. The cost to the Reserve Bank associated with the insurance proposals is estimated to be in the range of $2.5 to $4 million per annum on an ongoing basis once the Prudential regulations proposals for insurance have been fully implemented. The new insurance prudential supervision regime will generate transitional and ongoing compliance costs. However, the new costs will be largely incurred at the transition stage to the new regime. Also, the overall marginal cost to industry is mitigated by its relatively light-handed and comparatively non-prescriptive approach. In addition to this, foreign-owned insurers operating in New Zealand are already subject to a degree of regulation by their home country supervisors. The regulatory impact statement concluded that the benefits contained in the regulatory regime outweigh the costs. I would like to outline some of these costs now. Now, insurers will incur a cost in applying to be licensed under the regime. This includes the cost of familiarisation with the new regulatory requirements, self-assessment against the regime, preparing an application, dealing with the bank as a supervisor, and making any organisational and business changes needed to qualify for a licence. The proposed regulatory and supervisory requirements will impose additional compliance costs on insurers, including the need to maintain structures to verify compliance with requirements, to maintain capital in line with minimum standards, and to report regularly to the bank. But, Mr. Speaker, these are not onerous requirements or costs at all. They're not expected, these costs are not expected to be significant relative to insurers' revenue, and profits are not likely to affect the ability of insurers to continue to provide insurance service at current levels. This was one point we made very clear at FEC. Although the impact on small insurers may be proportionally greater than for larger insurers, we recognise this. Once insurers are licensed, these costs are likely to be routine costs of doing business, and we do not believe represent a material increase in costs over the status quo. Compliance with capital adequacy and solvency requirements may place constraints on insurers' business operations to a small degree. These requirements and the associated costs are generally aligned to internationally accepted prudent practice for the insurance industry. The regulatory reporting and public disclosure requirements will impose some additional costs on insurers beyond existing levels, but these are not expected to be significantly relative to insurer revenue and existing public reporting requirements. The costs will be higher for those insurers that do not currently have to comply with the Financial Reporting Act 1993. The proposed mandatory requirement for insurers to have a financial strength rating will impose additional costs on those insurers that are not currently rated. Ratings are already mandatory for most general insurers, and a number of other insurers have voluntary financial strength ratings. It is just common sense if you want to attract consumers into your financial institution, Mr. Speaker. Not your one, I mean into... The annual cost to insurers of having a rating is expected to be in the range of around $30,000 to $40,000. There will be indirect costs associated with ratings, such as management time and the provision of information. In some cases, the costs of ratings will be absorbed by insurance providers, while in other cases some or all of the costs might be passed on to policyholders. In order to minimise costs for those that can least afford it, the bill proposes an exemption for certain very small insurers with annual gross premiums below a prescribed threshold. Mr. Speaker, the bank has the power to require information from insurers, which the bank can require to be audited at the insurer's expense. There will be costs incurred by insurers on a case-by-case basis. There will be costs incurred on a case-by-case basis who breach regulatory requirements. In both cases, the bank will adopt a risk-based approach to supervision, meaning only non-compliant or at-risk insurers will face specific costs. There are a couple of risks with the legislation. Licensing requirements may represent a barrier to entry for potential new market participants, and increased supervision may reduce market discipline on insurers and increase moral hazard. Mr. Speaker, in conclusion, the reason why we are supporting this bill, why Labor is supporting this bill, is that it is another step in achieving clear, robust laws and regulations across the financial sector. The second reason is that it will provide a much higher level of security to New Zealanders with exposure to the insurance industry. And the third reason why Labor is supporting this bill is because it is important, because it tidies up legislation around the sector where there was an unacceptable level of uncertainty. Mr. Speaker, I commend this bill to the House. Thank you.
Call Aaron Gilmore.
Thank you, Mr.